Eddy Gifford, wealth advisor at Tactive. But now what? You're starting to think that there could be a case made for some picking. Why is that? You think the markets are oversold, or just some really great companies are too oversold?
I think it's a little bit of both. Obviously, we've dealt with a lot of issues when it comes to political tension, when we've dealt with conflict, we've dealt with inflation and elevated interest rates, and all these things keep going on. But when everything starts to get bad and starts to get worse and starts to get worse, it's where you start targeting the names that you always wanted to own, right? And so we're looking at companies like Microsoft, companies like Apple, where we're not necessarily saying, hey, it's time to jump all in right now. But we think that if you have a good investment plan, as we've talked about in the past, this might be an opportunity to start adding. Now, if we're thinking of adding over the next 12 to 18 months. We do think there is more downside in the market, but downside isn't necessarily a bad thing. When you're dollar cost averaging in, you're able to buy more and more and more and more shares. And both Microsoft and Apple are great companies that we think will be around 10, 15, 20 years from now and still be profitable. So we think that both names are good, and we think that there's a lot of opportunity there. But we also think that, like anything else, as I've preached over and over and over again, you got to have a plan, right? And so that's why we like those two names right now.
Right, understood. And I get what you're saying, and especially as you go into the holidays. I used to have a trader friend who said, you never short Apple in the fourth quarter, just because everybody wants something Apple for the holidays and they have their whole ecosystem. And at the same time, it really has been beaten down because there have been concerns about how much demand there actually really is for the iPhone 14. In fact, people are willing to pay a higher price for the product, right? So with Apple, what numbers do you watch most? Demand supposedly is lower, but you said you would start building at around 120. Talk about the numbers a little bit and the timing.
Yeah, I think ideally, if we could get Apple around 120 to start building a position, that would be fantastic. I don't think that you're necessarily in a bad situation if you started now, but I do think that the waning demand could affect things, but that could actually end up being a positive from the standpoint that if Apple is saying that demand is waning, then that could mean from a big picture standpoint that deflationary things might start to happen, right? And so if that starts to happen, we could see inflation potentially begin to fall a little bit further. And that could be a good thing, because that's what we're all looking for is, hey, is inflation going to continue to stay stubborn like it has? Is it going to continue to stay elevated, or is it going to start to fall? Well, Apple may be starting to tell us that, hey, it might start to fall a little bit. And so even if they underperform short term, relatively speaking, we look at that as kind of an opportunity to say, hey, maybe we're closer to the bottom than not at this point. So, it's impossible to actually time the bottom, but if we move into a company like Apple over the next 12 months, even if it falls and then comes back, we have a lower average share price and we're positioned really, really well over the next 10 to 15 years.
Right, understood. And tell me again the numbers on Microsoft. I know we have a few other things to discuss, but your Microsoft, you said, is a buy as well. That's over the 220 level.
Right. We like Microsoft at 223. Like if I hit 223, we would definitely initiate a position. But it's kind of the same story there. We think that Microsoft and Apple are obviously kind of the generals of a lot of indexes right now. And so could they fall a little bit further? They could, but they're also going to be the ones that lead us out of the hole. So starting to build positions in companies like those over the next 12 to 18 months puts us in a really good spot 10 to 15 years from now. But we like Microsoft just because it's a different play, right? Like Apple is more mobile, Microsoft is more business, and we do think that in the long run, America wins from a business and consumer perspective. So both of those companies are good ways to play those scenarios.
Okay. And then what are these ETF picks we need to talk about? You have Nope, a new fund. Tell me a little bit about that one, and then we'll get to the second.
So Nope, this is actually George Noble's fund, and this was just launched recently, and we've been looking at it. It executes a lot of the strategy that I've been talking about for the last 6 months, have a plan, have a predetermined reason to buy something, a predetermined reason to sell something. If markets are not in your favor, it's okay to be inverse or short to market. If markets are in your favor, it's okay to maybe add a little bit of leverage, right? So we think that this could be kind of a good absolute return type mentality. It's almost like a hedge fund, if you will, for everyday investors. And so if someone just wants to they don't have the patience to put money into something over the next 12 to 18 months, well, this is something that you could put the money in and you're not going to see a significant move up or down for that matter over the next day or the next 3 days or the next 5 days. But in the long run over a full market cycle, it could make money in both a down market and an up market. So it gives you an opportunity to create some consistency potentially with your portfolio.
Yeah, understood. And last but not least, when we look at AX, SPX, tell me a little bit about that.
So this is kind of like an interesting play. It's very similar to Note from the standpoint that it's more of an absolute return, actively traded strategy. This is actually a mutual fund, believe it or not. I think it's the first time that I've mentioned a mutual fund on here. But the reason we like it is for a couple reasons. One, it's using managed futures on the S&P 500, and so that actually gives us a little bit of tax benefit, even though it's actively traded. And it can go, same thing, it can go up to 100%. 150% long, it can go up to 100% short, but it's actually in and out. And so we saw in September as an example where we know that was a bad month for the stock market as a whole. This fund was actually up. And so again, it's like one of those things where it already has rules-based strategy, it already has the quantitative analytics. You don't have to make decisions about when to buy or when to sell because that's already predetermined for you. And so you can use something like this to be kind of the active side of your portfolio while you are building up the big names that you really, really like on the other side and put yourself in a position where you can potentially do well even if the market goes down over the next 18 months, but really be positioned well after that 18 months kind of passes and we find ourselves in a situation where things are starting to run up again. Well, now we own the big companies. So at the end of the day, like we've always talked about, portfolio construction, having some different types of things in the portfolio that can do well in different markets so that you're not being hurt too bad on either side.
Right, understood. I mean, it really is a turbulent market, as we were saying, Eddy. And these are some ideas how to get through it. Eddy Gifford, thank you very, very much. Good to see you. Wealth advisor at Tactiv. Thanks. Coming up next, hey, let's examine the utilities sector. Why it